Good afternoon, everyone, and welcome to the August 2025 edition of Epic Insight. My name is Mark Panasuk. I am the Northeast Sales Consultant at Epic Retirement Plan Services, and I will be your host for today's call. In today's Epic Insight, we're going to dive deeper into the topic that has become very important for many of our clients, cash balance plans. Cash balance plans can be challenging because of their highly customized, complex designs, but advisors that master the concept and or partner with experts like Epic are presented with an opportunity to expand your client base of high net worth individuals, increase your assets under management, and most importantly, solidify the relationships you've worked so hard to build. By leveraging the power of a cash balance plan, business owners can maximize the potential to defer more taxes, unlike a standalone 401k plan, helping them to supercharge their retirement plan savings. On today's webinar, we will walk through some case studies to illustrate the benefits of a cash balance plan. And to help us navigate this incredibly important topic, we're happy to have one of my colleagues and internal specialist, Karl Willman, Director of Actuarial Services here at Epic. Karl has nearly 20 years of experience administering and designing defined benefit plans, with a particular focus on cash balance plans. He helps companies maximize their retirement and tax savings through qualified retirement plans. He is recognized as a trusted advisor to his consulting clients, as well as financial advisors. Karl is a fellow of the Society of Actuaries, an enrolled actuary, and a member of the American Society of Enrolled Actuaries. Your line will be muted throughout the call, but if you have any questions you would like to address, please enter them to the right in the webinar control panel, and we'll address them at the end of the session. And with that, before I turn it over to Karl, I'd like to say I very much appreciate having Karl as a resource here at Epic. I enjoy the process of working with my advisors, their clients, and CPAs to discover the potential of cash balance plans. And I hope everyone on this call today will be able to take advantage of his expertise well beyond this presentation. And with that, Karl, I'll pass it over to you.
Yeah, thanks, Mark. Good afternoon, everybody. We've presented on cash balance plans a few times in the past, so to make this, I guess, a little bit different than what we've seen in the past, we're going to focus a little bit on some plan design options and some best practices. So we'll still kind of start from the beginning and kind of talk about how we build our plans. So starting with the basics of what is a cash balance plan, it is a type of defined benefit plan. So you think of a traditional pension plan, but it's commonly called a hybrid plan because it looks and feels more like a 401k plan. Right? Participants and business owners understand conceptually a pay credit and an interest credit a lot easier than they do an annuity stream at retirement age. And that's the main focus. It is still a benefit defined in the plan document as to what that pay credit is and what that interest credit is. And it is the employer's obligation to fund that plan. But it looks like a 401k plan that everybody has an account balance and can conceptually see, I've got this much in my account for retirement. So again, the two main pieces are a contribution credit, and this is typically a percentage of their annual compensation or some flat dollar amount or a combination of both. And there is an interest crediting rate. So each individual participant, their benefit is promised to grow by some rate set forth in the document. So the most common things that do that are either a fixed interest rate or tied to some index. So this is where we really want to kind of get into the meat of what we haven't talked about in prior sessions, is the types of different interest crediting rates. So the most common thing for the vast majority of our small employers is a fixed interest rate. And it's limited to 6% as the maximum you could do. Most of our plans are set up around 4 to 5% for most of the times. And that just seems to give the most consistent results from year to year when there's a fixed rate. Things don't change as much. It's a little more predictable. Before fixed rates were popular, a lot of the plans were tied to an index like the 30-year treasury rate, right? So there's a little bit of volatility that, typically in up markets you can earn a little bit more, and down markets you don't have to earn quite as much because the treasury rate will move, but it doesn't move a lot. And that seemed to be a little more confusing to people than once the fixed rate became an option. The thing that's not necessarily new, but gaining a lot more popularity recently is the option to use the plan's asset performance, which is called a market rate of return cash balance plan. And that's where, exactly like it sounds like, it looks even more like a 401k plan, where if the account goes up by 5 or 10%, your cash balance personal account will go up by 5 or 10%, and goes down as well. So it ties more closely with the actual investments. So pros and cons of market rate of returns. The main pro is to lower your asset return risk as an employer trying to fund and manage the assets of this plan. So there's a little bit less downside risk to this plan. Your assets and your liabilities will more closely line up. It will never be exact because of the timing of contributions and distributions and everything. That they'll be more closely match your assets to everybody's specific account balance. So instead of trying to earn a 4% fixed rate of return, now you've got a little bit of flexibility that balances will go up or down based on that. And again, more closely mirrors DC plans that people can understand that their account balance went up based on what the entire pool of assets went up. Now, there are some cons to that. And the cons are mainly focused around what happens when you have wild swings in your investment return. So if you're invested conservatively, it shouldn't be too much of a problem. But if you have a large return, you get a 20% return one year because you're trying to get as much as possible. The way the rules work for all of our testing purposes is you use the most recent year's rate of return to project benefits forward to retirement age for all of our testing purposes. So that can get some really strange results with non-discrimination testing. When these plans are paired with a 401k plan for testing, we get some really large benefit accruals because it's two pieces, right? There's a benefit, there's a pay credit and the interest credit. And if that interest credit is high and projected to be high for several years, that year's benefit will be much larger to test in the combined plan testing. And kind of counterintuitive, maybe the high returns can reduce the maximum distributions. That's under the code section 415 is the maximum distribution you can get out of a plan. So same kind of concept where if you have a large 10 or 20% return, we're projecting that forward for several years. That's going to reduce what you can get out of the plan at the end. So I guess there's a cumulative floor is a con there. It could be a pro, I guess, depending on how you look at it, but that's where it's another reason it's not always going to line up the assets with liabilities. The cumulative floor is a preservation of capital rule where the participants can never be paid out when they leave employment or the plan terminates less than the sum of the pay credits they got along the way. So any single year could have a negative return applied to their account balance, but once that person cashes out, you've got to make sure they have a long-term 0% minimum interest credit. So again, if you have years where your investment return goes up or down, some of these things come into play that won't make it line up exactly. And lastly, it's more complex, right? To do the evaluation, to do the testing, to do the benefit calculations, more complex to administer and typically more expensive as well compared to a more common fixed rate return for small employers. So what we do if someone's interested in a market rate return plan is you have to consider using a cap. So usually that cap, maybe 5, maybe 6%, that says in any given year, your interest credit rate is the rate of return on plan assets, but not greater than 5%. So if the investments return 3%, everybody gets a 3% return. If they get 10%, everybody's capped at that 5% return. That really solves most of our issues with the non-discrimination testing problems with the high projections and the 415 problems. So that's really critical for small employers who are trying to maximize the benefits in these plans to avoid those issues. So a couple reasons to do that as well is that It preserves gains in high return years to offset losses. So, if you've got a 10% return one year and a negative return the next year, that person, you've still got a little bit of excess assets to be able to pay people out that cumulative 0% floor long term. So you've got some extra assets in there. The last bullet point is a little bit different, and I just want to bring this up because it's difficult in these large plans where say more likely to be able to pay in-service distributions, and not necessarily in-service or even retirement distributions, and that's focused on highly compensated employees. There's a rule referred to as the 110% rule, where for one of the highest paid, highly compensated employees to receive a distribution, the plan has to be 110% funded after that distribution to allow that to happen. Spirit of the rule is to make sure that HCEs don't take out their money out of the plan and cripple the plan and take too much money out. There's not enough to pay everybody else out. And that's not necessarily a dollar for dollar on a termination liability, account balance basis. It's based on our annual valuation reports, which is kind of a present value calculation. But you can see where if you had a plan where your assets and liabilities were always in step, you're 100% funded because your investment interest crediting rate went up and down based on the plan assets. It's hard to be 110% funded if everything lines up. So again, a cap will allow you to potentially have some excess returns in good years where your benefits don't necessarily grow quite as high, and you've got that opportunity to meet that 110% rule. So if you're prospecting clients, employers, plan sponsors as to who would be interested and who's ideal candidates for a cash balance plan, it's typically high income business professionals with strong cash flow. Yes. We would say doctors, dentists, lawyers are pretty common. The medical industry has historically been the biggest users of these plans. Nothing magical about doctors having a lot of plans, but doctors consistently have high income, and it's predictable from year to year. Strong cash flow is important because there are minimum required contributions every year. We do have set up plans in other industries, real estate and construction, where income is a lot more volatile, but they've got to make sure they're committed to funding that plan for this foreseeable future to make sure that you meet all those minimum required contributions and avoid any excise taxes or other penalties. So we can put a little bit of flexibility into it where the benefits are based off of pay, but again, it gets a little bit trickier if somebody needs a tax deduction one year and they don't the next. We got to make sure it's consistent from year to year. And again, entities looking for the tax deductions, it's typically the main point for these retirement plans, right? It does provide a nice balance of money at retirement age. That's usually the secondary focus. These are usually set up because somebody's looking for a solution to pay less in taxes. And last one, owners close to retirement age. And that's for a couple of reasons. We'll see some charts here in a little bit that shows the amounts of benefits that business owners could get out of cash balance plans or defined benefit plans. Those are based off of age and pay. And the older you are, the more you can put into the plan because you have a shorter time horizon to get to the maximum benefit. But also for testing considerations. Anybody that's familiar with the way most of our 401k plan testings work with that new comparability of profit sharing, where you're kind of comparing benefits for everybody at retirement age. Again, the bigger the age disparity between the owner and any rank and file employees makes that testing results work out better. And the cash balance plan is really just adding another layer on to what those standalone 401k plans do for those testing. The next step is looking for people that want to have a cash balance plan. Typically, they already have an existing DC plan. We're not replacing the defined contribution plan. Typically, it's adding on for people that are already saving and are looking to do more. So, in a standalone 401k profit sharing plan, you can get about $70,000 to a business owner between all the moving pieces there, deferrals, safe harbor match or profit sharing. And so we'll look at the cash balance plan. We say if you're already putting in 70, it really doesn't make sense to put it in a cash balance plan unless with the additional, employee costs and administrative costs, unless you're going to put away $100,000 or more per business owner, per principal. Say kind of a rule of thumb in a combined plan is that the employees are going to receive most likely at least 7 to 10% of their pay. That's between what we have to give for minimum benefit purposes in the cash balance plan and the minimum gateway, minimum top heavy testing requirements in the defined contribution plan. So combined, we're there. It could be more depending on the demographics and what benefits the owners are receiving. But if you already have somebody that's giving a generous benefit, we might be able to add a cash balance plan on for not much more additional employee cost. We see this if you have business owners that have a simple, they must terminate the simple, right? There's some recent law changes where you could switch mid-year from a simple to a safe harbor 401k, but we do not believe that exception applies to cash balance plans. So if you had somebody with a simple today, we're looking at a cash balance plan for 2026. An owner with a SEP IRA, it depends. We have to look at it, what they've got in place. If it's an individually designed SEP, it kind of depends if they funded it or not. If not, we might be able to unwind that and start up new, 401k and cash balance plans. If it's the IRS prototype SEP, and I believe that's Form 5305, then that's same language as a simple, where that must be the only plan of the employer. In the case where even if they could contribute to both a SEP and a cash balance plan, we still typically advise it to terminate that SEP and start a 401k anyway. A lot of these plans, there are some multiple plan deduction limits where you can't maximize both plans. A lot of the times the employer contribution to a profit sharing contribution or a SEP contribution is limited to 6% of the payroll of eligible employees. So the advantage of even in an owner-only plan that has a SEP, they could do their 6% in profit sharing or 6% of SEP, but the 401k will allow them to do their 401k deferrals as well, that $23,000 or $30,000 with catch-up. That the employee deferral piece does not count towards that 6% limit. What types of business entities need cash balance or can use cash balance plans? Really, anybody can. We just have to know how they're taxed, what their entity is, and how they're taxed up front, because it goes into the plan design. S corps, just like 401k plans, if you're familiar, can only use the W-2 compensation. It's pretty common that we'll come across people that control their W-2 to keep the payroll tax down and take the rest of that as K-1 distributions. That income doesn't count for our calculation purposes. So probably need some conversations with the CPA to make sure they're aware. To balance out if this makes sense, there probably will need to be some additional W-2 and additional payroll tax associated with that. Might eat into some of the tax savings of the cash balance contributions and deductions. Sole proprietors, partnerships would have earned income. It's kind of a circular calculation, right? The benefit in the plan typically is tied to a percentage of their pay. That pay for a sole proprietor then is dependent on what they deduct. So we kind of have to go back and forth if you're not above that maximum income threshold. So we just got to know that up front. We need to collect that data up front to run any illustrations to make sure we got the right plan design for that instance. We got some tax deadlines there based on how incomes are taxed, how entities are taxed. Kind of to illustrate, plans can be set up after the end of the plan year, before their tax return due date, if they extended their tax returns. So we've got plenty of time to do things. Realistically, you're at a time for 2024 plan years now that we're in end of August 2025. We have some internal cutoffs, but theoretically, you could set up a plan still for 2024 if you extended your tax return. If you have somebody that has the ability to get that done for you, that quick turnaround. But we probably have an internal cutoff usually around the end of June for retroactive plan adoptions. Another point about these tax deadlines listed here is that the minimum funding due date for defined benefit and cash balance plans is always up to 8.5 months after the end of the plan year, assuming you've extended your taxes. So it's September 15th for a calendar plan year. It does not matter if it's a sole proprietorship that has until October 15th to file their taxes. Minimum funding is always due by September 15th. There's not much legislative changes recently, but Secure 2.0 obviously is the hot button topic here, and I'm sure a lot of people have sat through lots of Secure 2.0 updates around plans the last couple of years. We want to highlight some of those changes that apply to DB plans and cash balance plans, because there was 90 something articles on Secure 2.0 that the vast majority of changes apply to DC plans, but there are a couple that apply to DB plans as well. Like the minimum distribution age is up to 73 now, will eventually go up to 75. That's great. We hate calculating minimum distributions, those are a pain. So later as possible is good for us, and less taxation, leakage of benefits coming out of the plans. Then the third bullet point there, no indexing of PBGC variable rate premiums. I'll back up a little bit. The PBGC, if you're not familiar, is a government entity, the Pension Benefit Guaranty Corporation, that basically insures defined benefit plans. So if something were to happen to the company and they go bankrupt, the government will come in and pay benefits to the retirees and their employees to some degree that they've been protected. So there is a premium to that. You have to pay a fee every year. There is a flat rate fee that's just a per head charge. And there's a variable rate premium that depends on how well funded the plan is. So if your plan is underfunded, you're kind of deemed to be more at risk to needing the PBGC to come help and pay benefits as they're due. So you have to pay a percentage of the amount that you're underfunded as part of your annual premium. So it didn't really make sense. Both those fixed rate and variable rates increase every year with cost of living adjustments. It didn't really make sense that variable rate was as a percentage kept going up with cost of living adjustment. That really didn't have anything to do with cost of living. The percentage is now fixed, so it's 5.2% of the amount that you're underfunded on your valuation is paid as part of your annual premium. So that's a win. That's a good thing for us to try and reduce the premiums. And then, just like DC plans have this as well, retroactive discretionary amendments to increase benefits beginning with the 2024 plan year. So that's great. That kind of puts existing plans on a similar playing field as startup plans. Retroactive plans can do whatever they want at this point for 2024 because nothing's in place. Now we can increase benefits retroactively, and that's really gives a lot more flexibility for our plan designs. So for a couple of reasons, we're doing valuation reports for 2024. We're wrapping those up now with minimum funding due here in a few weeks. If somebody had already put in too much money that's more than the deductible, you're in a spot where you've got potentially excise taxes on that amount, or maybe the contribution needs to be returned, or you've got non-deductible contributions. Now we may be able to amend the plan if the benefit's not already at the maximum to increase the benefits retroactively to allow that funding to stay in the plan. The other great consideration is testing failures. If a plan previously failed some testing considerations, we can do these 11G amendments to increase some benefits to pass testing. Those 11G amendments had to be non-discriminatory on their own. So typically, if something fails, we have to increase one of the non-highly compensated employees. But now this retroactive discretionary amendment, we can increase an HCE if we want to. We can bring in, we can increase the owner's benefit if that helps something. If we can bring in the spouse to a bigger benefit, that helps the testing. As long as the overall 2024 plan year still passes testing, that's a great thing. The only difference between the two, this retroactive discretionary amendment has to be in again before you file your taxes, including extensions. So the 11G amendments have until, for calendar years, October 15th. So there's a little bit of a gap there where if your tax return deadline is due by September 15th, it's too late to do a retroactive amendment at that point. But we could still do the 11G amendment. So they'll still come into play, but there's a lot more flexibility than there used to be. All right, what's the role of the advisor? This is, the financial advisor is the trusted financial counselor, right? It's hard for me to go to a doctor or a dentist or a lawyer and sell them a cash balance plan, right? They go to the people that they trust to help them make their business decisions. You will be their plan design advocate to help them, kind of facilitate with us about what they need, how much money they wanted to put in the plans, what's the best, structure for their company. And then once things are set up, the advisor can determine how involved they want to be, right? If they want to be the point person and be the go-between between everything on the plan, that's fine. If you just want to step out of the way and say, hey, you got it set up, just let me know when you're ready to fund. We'll help you with that. That's fine too. But we kind of look through advisor partners to help us expand our network and help educate everyone on the plans and get them set up. How are the investments different? And this is compared to a 401k plan. 401k, just like your personal assets, the goal is almost always the largest possible investment return for your risk appetite. That's not necessarily the case in a cash balance plan or a DB plan. There's no participant direction of investments, right? This is all employer money, which means there's also no employee education that has to go along with this. It's one pool of money typically in a pool account, so you get invested for economies of scale there. But again, the return is not necessarily the maximum return is not necessarily the goal, because it's structured around the plan design with whatever interest credit rate we've picked. So if you picked a fixed 5% or even a market rate return with a 5% cap, your goal is really to aim for that, roughly that 5%. I think there's not really much upside to getting quite a bit more. And if you get 7% one year and 2% the next year, it's not a problem. That's really the wild swings you want to avoid. If you have too much money in the plan, if you go out and get a large return, it might mean you can't put in as much money the following year, which means you're not getting the tax deduction. And on the flip side, if you take that risk and underperform, you have to put in more money over time to help catch it back up. And then at the end of the day, whenever this plan terminates, kind of the same thing. If there's excess money in there, it typically gets split up amongst the participants, hopefully based in kind of in proportion to their account balances. But if it's underperformed or lost money, you have to put more money in, or the owner takes what's left. You pay out the rest of the benefits, and the owner takes the haircut. So there's a lot more downside risk than there is upside risk to trying to manage for large return. So because of that, most plans are structured to reduce their volatility. And think of this more as the conservative piece of the overall portfolio. Think of this the conservative piece, put more risky investments if you want to do in the 401k or your outside assets. So what are the 415 limits? And the 415 limit is our Internal Revenue Code section that describes the amount of benefit you can get out of the plan. So in a defined contribution plan, you're probably familiar with that. They limit the contribution that can go in annually. In a defined benefit plan, they limit the distribution, the benefit at retirement or when you terminate employment. Right now, that's defined as an annual annuity of $280,000. That is subject to cost of living adjustments as well. So if you convert that to a lump sum with their assumptions they give us, that's roughly $3.5 million today. But that limit is, it's not $3.5 million for everybody necessarily. It depends on age and pay and how long the plan's been around. So that $3.5 million, that lifetime limit is prorated. If you have less than 10 years of participation in the plan, the compensation has to be at least at high as well, above that $280,000 annual figure. That's an average compensation, and it's reduced before age 62. So we kind of work backwards and say, what can we put in today that's not above the limit for 1 year participation, but also what can I put in today if I have 15 years to age 62, or if I have 10 years of horizon to do the plan? What can I start putting in today that's going to accumulate towards that $3.5 million, potentially, if you want to maximize the design? And that last point is important now. It's coming up more and more as cash balance plans are more widespread, that you have to aggregate all defined benefit plans of the employer and successor and predecessor employers for these 415 limits. So if you had, a person that already had a plan and maximized, they got their $3.5 million out a couple of years ago, they can't start up another plan and get another $3.5 million. So that's coming up more and more now that people are saying, no, I used to have a DB plan, now I want to start, contributing again. And that's fine. There may be some room to contribute again, but we've got to look at those prior distributions and offset that towards what they could get today out of the plan again. So here's the limits for 2025. It's got a lot of numbers on the screen, just to show you what is possible for each, for each individual in a plan. Assuming their compensation is typically at least this high, we typically don't make a benefit above a 100% above their annual compensation. So if you had a 50-year-old business owner that wanted to put it in the cash balance plan, if they had the cash flow and the needs of the tax deduction to do so, we'd start with this chart and say they could put away $197,200 in a plan each year. Now we've got to, go through those exercises and see what that means for the staff costs to pass all the testing results. But you can see how the older you are, then you get more money as you can get at age 62. That's 1/10 of that dollar limit. 1/10 of that limit, $3.5 million. So 10 years in your 60s, you can get to $3.5 million pretty quickly. There's nothing special about the ages we show on the chart here. Plans can be set up before age 36. We don't see it a lot, but again, if you're not putting away more than $100,000 combined, it's usually not worth the additional hassle or the staff costs associated with young owners. But we've done it. We've got some plans for youngers if there's no employees, especially. And we set up plans for people much older than 65 as well. I mean, there's no maximum age to set up a plan. There are the minimum distribution rules. So at some point in your 70s, you're going to have to start taking money out of the plan as well. So that might cut into the tax savings of having a plan, but it certainly can go on. These numbers get bigger as well. There's a little quirk in the law where things are decreased before age 62, but increased after age 65. So that present value of that number goes down a little bit for a couple of years, but after 65, these numbers start going back up again. So that was the bulk of what we're going to do. I wanted to run through a couple of examples, and we'll go through this fairly quick. If you've seen some of our presentations before, these will look familiar. But I just wanted to show how powerful this can be and for the right situations. So the first one is very straightforward. There's a business owner, age 56, with income of at least $350,000. That's the maximum income we can count for retirement plan calculations for 2025. And there's no employees, right? This is great. Everything they put in goes back to their own pocket. There's no employees to worry about testing. It's really about a conversation about what their cash flow is and what their tax deduction needs are. Kind of putting together a couple pieces of things I discussed earlier. The PBGC covers most plans, but plans are exempt if they only cover business owners, substantial owners, like this one would be the single owner, and the professional service groups like a medical practice or a law firm or accounting firm. The professional groups of 25 or fewer participants are exempt from coverage as well. So it's usually a good thing. We want to avoid additional government coverage if we can. But if you're exempt from the PBGC, there is a limit on the DC contributions to 6% of pay. If you go over that 6%, then the combined plans are limited to roughly 31% of their total pay, and that's much less than some of these numbers we're talking about, what you could do in a cash balance plan. So that's typically the goal is to limit the profit sharing or limit the employer DC contributions to 6%, and then maximize the cash balance. So if we look back at that chart a little bit ago, at age 56-year-old business owner could put away $265,900 into a cash balance plan. So backing up there, they've got the maximum W-2. Their employee deferral with catch-up above age 50 is $31,000. And then $21,000 is 6% of their W-2 salary that we can take. So big picture there is instead of saving $70,000 or $77,000 with catch-up deferrals in a standalone 401k plan, Now the combined plans will get them over $317,000 of contributions and very substantial tax savings of potentially $127,000 there. And again, no employees, that is as simple as it gets, really. So here's another one that shows a small law firm. So 2 partners with 3 other employees. And just to show what potentially could happen here, think of the existing plan. In the cash balance plan, I'll start over the cash balance column. We have to show at least 40% of the eligible employees have a meaningful minimum benefit. So in this case, 2 partners out of the 5 total employees satisfies that rule. If this group ever brought in more employees, we'd have to benefit some other employees in the cash balance plan as well. But in this case, we can have the cash balance plan just for the partners. The employees don't have to participate. Now, that is discriminatory, right? You can't have a plan like that on its own. So it is still paired with the 401k profit sharing plan to pass all of the IRS non-discrimination testing. So you can see there, partner 1 is putting away quite a bit in the cash balance plan. Partner 2 is putting away something less. That's a point here to drive home, that you have multiple partners that don't have to put in the same amount. They can each put in something different. Employee 1 there would be considered a highly compensated employee, and you can discriminate against the highly compensated employees as much as you want. So in this case, we can exclude employee 1 from all pieces of the plan. We don't have to give them anything. Now, employees 2 and 3 are getting substantial profit sharing allocations to make this work. So, this could look better if these were a couple of 21-year-olds. This is a real world example of some of our data. Those employees are probably maybe not much younger than the partner, so those are substantial profit sharing allocations as a percentage of their pay. But look at the bottom right there, 94% of the total dollars that these partners are putting into the combined plans are going back to them. And the employees are much better off because of the cash balance plan than they were without it. They were not going to get $18,000 and $12,000 respectively in the profit sharing plan without the cash balance plan around. And without the cash balance plan, those owners would take that as income, and it's going to be heavily taxed. So we're going to get a lot more into the plan back to the owners than if they were to pay income tax on it. So it can work for larger groups as well, right? I just can't put 100 participants on a screen or more for everybody to look at. That would be kind of ridiculous. So again, that first participation requirement is the lesser of 40% of the eligible employees or 50 individuals. So very large plans could potentially get away with only covering 50 people in the cash balance plan, even if you have hundreds or thousands of employees. But they're still tested together, so there's still a lot of cost in the defined contribution plan to make that work. So you lose a lot of leverage if their employee group is significantly larger. So kind of my personal rule of thumb is if there's more than 10 or 12 employees per principal that we're trying to maximize benefits, the employee cost may be prohibitive. I said earlier, it's roughly 7 to 10% of the employees' pay to make this work out typically. So if you're not getting quite that much, it might not make sense. But again, these large plans that have a lot of employees, you got to look at the marginal cost of the plan. If you're already providing employees 5, 6, 7% of pay in the DC plan, you might be able to add a cash balance plan for minimal increase of employee cost. So look at that. You might be able to, the total results don't look great. Maybe it's only 60% back to the ownership group, but the additional dollars you're putting in by adding a cash balance fund, maybe again, like that other design, 90 or 95% of the money, of the additional money going back to the owners. So kind of to end here, some best practices we try to stress when designing a plan is to keep the CPA involved from the beginning. It's happened multiple times where some business owner reads an article or has a friend tell them about a cash balance plan, and we set one up. They think it's great, but the CPA was never involved. They say that they didn't need a deduction. They're whatever. They're running out of loss, so they had some carryovers from prior years. So keep the CPA involved to make sure this is appropriate for their tax situation, because again, this is a tax play for most part first for small employers. It is an employee benefit plan. That's typically the secondary benefit. We say to have your care plans together with one provider. It's not a rule, but we say it works best if we're working on both plans, right? If Epic has the cash balance plan and the 401k plan, we've got data on the same systems. We're talking to our own team members to make sure that all the testing of the allocations are working correctly. If the 401k is handled by an outside TPA, we can communicate the results and say this is what you're supposed to be doing in the 401k plan for the combined plans to work, but we have no control over whether that's done correctly or not. Obviously, then there's efficiencies to be gained by having fewer people touch it and fewer requests for data. Again, emphasize the tax benefits over the investment growth. Taxes are the main reason here, especially with younger business owners. They see a 5% cap or a 4% fixed interest crediting rate and think, I can do better than that outside of this plan. That's not why I want this. Well, again, that's not the first goal. Again, think of this as the conservative piece, take more risk outside of the plan. And then once this plan has run its course, if this plan lasts for 5 or 10 years and you roll your money out to your IRA or into your 401k, then you can invest it however you want. But while it's under the umbrella of this plan, trying to get the tax benefit, it's meant to be kind of reduce the volatility. And keep it simple. There's lots of plan design options out there. There's lots of tricks for testing to pass all the testing rules. I don't like to design a plan that's right on the edge of failing, where any change in compensation or demographics are going to make this blow up. So we can use some of those tricks if we need to, right? We can do different testing methods. We can bring in other employees if we need to do that to help pass, but try to keep it simple so it's the business owners want this to be as predictable from year to year. They don't want to be surprised, right? So try to keep it relatively simple for everybody to understand and make sure there's not going to be any surprises for them. All right, Mark, do we have any questions come in?
It looks like a shy group, Karl, but I since we've done hundreds of these illustrations, I thought maybe I'd go through a couple of questions. We'll answer the first one question that they have, and you had already answered it. Is it too late to do a plan for 2024? And I think the official answer is yes and no. No here, we have a cutoff. I think it was end of June, and it's almost impossible to get everything done and do the illustrations, talk to the CPA, and actually get it accomplished for 2024. But legally, I guess you can do it up until September 15th, correct?
Yeah, exactly. It could even be up to October 15th, right? If your tax returns extend that way, but September 15th is the funding deadline, so you could be in a position where you miss minimum funding if you don't get it in place by then.
Yep. So that being said, I just want to thank you, Karl. In the past 20 years of doing this, there's only one actuary that I could go to, well, a team of actuaries now that I could go to, and I feel confident and comfortable presenting with you. So it's actually part of our process here at Epic. So once we qualify these situations with our trusted advisors, the next step usually is to get Karl or one of his team members on the phone with the client and the CPA, just to make sure that we have all the correct information. And in my experience, and you can share your experience, Karl, 95% of the time when we do that call, things change. And right then and there, instead of going back and forth 10 or 15 times, Karl can literally manipulate the numbers with the correct information the CPA provides. Sometimes there's a control group that we didn't know about, that the owner didn't tell us about. So the real benefit of working with Karl and Epic is that we have a resource like Karl and his team that has the technical skills to really break down these numbers, but also the social skills so that he can actually communicate and present very well, as you've all experienced today. So thank you so much today, Karl, for presenting in the fashion that you do today in all the illustrations in one-on-one meetings that we've done.
Yeah, thank you.
One of the and going before we get into some of the questions, I think one of the things that is different in the sales process when we work with advisors on the defined contribution 401k plans versus the defined benefit cash balance plans, is we really have to work with the advisor and the client very soon, at the very start of the process to qualify the plan. We need to make sure that the client is going to be comfortable with the expense, as we've all experienced here with fee disclosure and the race to the bottom with record keeping administration on 401k plans. It's not the same with defined benefit plans, the cash balance plans. There's expense to these only because of the resources that are required and the customization that's required, and the movement of the business that you have to go back and forth with Karl and his team. So qualifying the lead in the very beginning, just to make sure that they are comfortable with the expense, they're absolutely comfortable with the commitment. So a lot of the times we get these opportunities, and maybe a lawyer had a windfall or had a cash influx in a specific business. I think we had a TikTok star that had come into some money. It has to be a commitment over a long period of time. Karl, can you, I know that you touched upon this, but can you just touch upon what is, the question always comes up, what is that commitment for these cash balance plans? Can you terminate these? What is really the process behind that? Because I know it's such an important factor behind cash balance plans.
Yeah, so there's no black and white rule, but the rule of thumb is, or the IRS's buzzword is permanence. And that doesn't mean forever. It just means that when you're setting this up, the intention is going to be ongoing for the foreseeable future. So we say rule of thumb, at least 3 to 5 years of having this plan around. If there's legitimate business changes, if you change ownership, you sell the practice, then the plans can be shut down relatively quickly. But that's the point is, yeah, the IRS does not want a law firm that has a 1-year settlement to get a big deduction in 1 year and then terminate this plan right away. So it is meant to be funded for multiple years in a row.
Great, thank you. And I know this question sometimes comes up when we first do the illustration. Do you actually have to have a 401k plan, or can you do just a cash balance plan?
It can work on a standalone basis. We don't see that very often because it's not the best, most efficient design. And, some of these designs we showed, 90+% of the benefits going back to the owners. That's just because of the way the testing works out, that the owners get the bulk of their money in the cash balance. The staff get the bulk of their money in the profit sharing. If you're to do it on a standalone basis, I think you lose 15 to 20% of that efficiency. So maybe you're looking at, 70 to 75% of the money going back to the owners in a standalone design. Now, if it's a single business owner, then maybe you can accomplish in a single plan what their goals are. But again, most of the time we're working with people that already have a 401k, and we're not looking to replace it. We're just adding on for bigger deductions.
And again, it brings back to the point where when we go through the process of analyzing these, it's so important to involve the CPA so that we know what other plans exist, what other circumstances exist with control groups or those other circumstances. So then we can really get to the point of where the rubber meets the roads with these cash balance plans is when we can gather the information, go through the illustration, and then the client, the CPA, and the advisor yourselves can see actually how the numbers work with each one of these plans, and how do we get to those maximum potential numbers and discriminate within the cash balance plan and lower those the cost to the plan sponsor, correct? One of the other questions that typically come up, we're flexible here at Epic. They don't necessarily have to be with one specific custodian. We work with multiple custodians, right? And they don't necessarily have to have the 401k plan with us either. So when they're looking at illustrations through Epic, and they have a 401k plan at Fidelity or Hancock or American Funds, they don't necessarily have to move it over to Epic to do that. They can work with other custodians and other 401k providers, correct?
Yeah, we said typically we prefer to have both plans administered by Epic, at least the TPA work, even if it's record kept somewhere else. But yeah, as far as investments, we can work with any custodian.
Perfect. I don't think I see any other questions out there unless someone wants to pipe in. Let me give it one more second here. Okay. Well, I think that wraps it up for today. Karl, thank you so much for having this webinar with us. Oh, Chris says there are actually several questions. Can you see those questions, Karl? Oh, it says
I don't see anything.
Oh, hold on one second. Bear with us. What we'll do, it's okay. Having a little technical difficulty with the questions, but as a reminder, we're going to be sending out a copy of today's presentation to all of you. We're also going to include in that, we have a frequently asked questions brochure that covers most of the questions, and any additional questions that have come through on this, we will answer those in the email. So you will have that follow-up email with the presentation, with the answers to your questions, and also contact if you want to take the next steps and explore the cash balance plan option with Epic. So thank you very much, and that is going to wrap it up for today's Insight Call 2025 August Cash Balance Plans. Thank you very much for your attendance. Have a great day.